Hi, welcome back to another edition of Flipper's Fun Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, December 2nd, 2015. Now, we're going to have a little bit of unconventional format that we'll be presenting. I'm going to be doing a webcam. We use our traditional slides, but I think many of you know that I'm an avid hockey fan and I actually play 3 times a week. A couple of weeks ago, I got hit from behind, I think called boarding, by a goon out there, and basically ended up breaking my leg. I got 7 screws put in the lower leg, lower right leg, along with a nice 6-inch plate, and they now have me on a non-weight bearing cast. I think many of you will be surprised to learn, though, that actually we saw about $11.6 billion come into the conventional fund business, and this is during a time that people were sitting on their hands. Investors were very concerned about the upcoming numbers for non-farm payroll reports. If it was too high, what would the Fed do? If it was too low, what would the Fed do? They were looking at the ECB. They wanted details on what the monetary easing was going to be. They heard that the regulatory authorities in China were basically looking into some of the brokerage firms for possible security violations. And even though we had some mixed news on the earnings front, the economic news was kind of ho-hum, was off and on, and I think investors were just waiting for those big numbers, non-farm payroll and the ACB report to come out. Well, let's see how that panned out as far as it breaks out to our macro groups. We saw equity funds lose about $4.7 billion during the week. Taxable bond funds about $1.8 billion in outflows. However, again, ahead of the tax season, right at the end of the year, people become a little bit more aware that Uncle Sam's getting ready to take a bite out of their returns. Municipal bond funds actually saw a little over $300 million. That's the trend we've been seeing over the last several weeks. And probably the biggest surprise that we saw was money market funds actually taking in $17.8 billion. Well, that's not too surprising when people are concerned. They put money into the market, I think, in anticipation of seeing some maybe a little late Santa Claus rally, but certainly tax loss selling and tax loss harvesting at the end of the year, which may drive down prices and bring in some good numbers for January. So be ready to do some pretty quick buying. Well, let's go ahead and take a look at how that impacted the individual groups and take a look at equity funds first. As I was saying, basically we saw about $4.7 billion in outflows, 4th consecutive week that we've seen outflows, but really it's only the first week in 3 that we've seen negative returns to the tune of 0.34%. Now, how that basically panned out is when we take a look at domestic equity funds lost about $3.4 billion, and non-domestic equity funds, and by the way, that's the 4th consecutive week they've seen outflows, non-domestic equity funds lost about $1.3 billion, the 3rd consecutive week that they've seen outflows. And so this is kind of a trend that we've been seeing just the recent last couple of weeks, because people have been putting money to work in the world equity arena for quite some time, and I think they're losing a little bit of confidence. Here's how it broke out, though. If we took a look at domestic equity funds, large cap funds basically saw net redemptions of about $1.3 billion. And if we take a look at the equity income funds, they saw net redemptions that were to the tune of about $700 million. But if we take a look at the kind of big playing area that's been receiving money, international equity funds also saw net outflows of $1.3 billion, and emerging market funds, which actually has been quite a favorite, saw about $700 million. So we know some of the smaller, maybe global, maybe some European, maybe some Japanese funds. Anyways, some of the smaller groups saw a little bit of outflows to round it off that $1.3 billion in net outflows. So certainly that was interesting. But what's even more interesting is the dichotomy that we've been seeing between ETFs and retail investors, and certainly this week was no different in that area as well. So let's take a look at the ETF universe. ETFs actually for the 8th consecutive week saw $3.8 billion of inflows this week, but they've seen positive inflows over the last 8 consecutive weeks. The big leaders were kind of the big guys, big dividend earners, the safety plays. SPY, Spider SP 500, saw about $2.7 billion. The iShares MSCI Eurozone saw about $333 million of net new money coming to their coffers. And then we saw the Spider Dow Jones Industrial Average taking about $250 million. So authorized participants were basically saying, hey, we think investors are going to come back in, but they're probably going to go after safe haven plays, and that's certainly what they played into as well. But then at the bottom, we saw kind of the big pariahs. We've seen gold losing money. We've seen actually natural resources. We've actually seen some biotechs taking on the chin as well. So gold, GLD, actually saw outflows about $566 million. We saw the iShares NASDAQ Biotech lose about $267 million. And that's certainly been kind of the trend that we've been seeing, kind of the big risk plays. Either people put a ton of risk on, but in the last several weeks, we've seen that risk off play come in, and certainly of concern. Now, one of the interesting things that we've been seeing as of late is fixed income funds, kind of a dichotomy there as well. But this time we didn't. If we take a look at the fixed income arena, we basically saw taxable bond funds lose money, about $1.8 billion. And this is the fourth consecutive week they've seen outflows. However, it's the third consecutive week they've seen plus side returns, 0.18%. Now, 0.18% is nothing to write home about, but keep in mind, this is a fixed income fund and it's a weekly return. So we're kind of surprised that we saw some of the outflows that we saw. But again, it's investors being conservative, anticipating the Fed may be raising interest rates. So we saw corporate investment grade debt funds lose about $737 million. Second consecutive week that we've actually seen outflows from that group. And we also saw flexible bond funds lose about $654 million. So certainly that has been a story we've been watching as well, as the big kind of risk on plays and people with some of the big portfolios, even on the retail side, people running for cover there. Now, here's that dichotomy that I was talking about, that when we take a look at bond funds or equity funds, there was kind of the dichotomy. This time we saw the authorized participant actually also bail on the fixed income channel. Let's go ahead and take a look at the ETF group and what happened there. They saw very small outflows, $243 million in net outflows, the first week in three that we've seen outflows out of this group. How it broke out, though, we had the Spider Barkley High Yield Fund ETF basically lose about $593 million. Now, iShare iBox investment grade corporate debt ETF LQD lose about $152 million. And then at the bottom end of this universe, we basically saw what we would expect. Again, we've seen the kind of short end of the curve raise. We saw about 19 basis point rise at the end of the month. On the 2-year, I think it got up to about 0.92%, and that's the highest we've seen in about 5 years. So it makes sense that we see the iShares 3 to 7 year Treasury bond lose the biggest money, about $450 million leave their coffers. And if you look back on that slide, basically that slide showed that it was all kind of Treasury short duration products that people were bailing on and kind of running for cover, and that was certainly the concern for a lot of investors. Let's go ahead and take now a look at the municipal bond fund universe, because that's where we had kind of a change of pace. We saw for the ninth consecutive week, $331 million this time enter the coffers. It's the third consecutive week we've seen plus side returns. Now the return was actually pretty phenomenal, 0.40% for weekly return for muni bond funds. That's really good. And for the ninth consecutive week, we see national munis taking money, this time to the tune of $345 million. And that would tell us, by the way, that when we're taking a look at these numbers, that means single state bond funds were actually losing money as well. And so maybe that's something that the investors could take a look at. They're maybe not so concerned about their individual states, more worried about the federal taxation issue as well. Most people are worried about all three. If they have a city or municipality, if they have the state, and if they have the federal, they want to take care of all three. But it looks like, according to the flows, national munis are getting most of the attention and most of the concern. Well, that takes us now to our last category, and that's money market funds. And again, I told you that they saw big money inflows. Second consecutive week they've seen inflows, but however, this week to the tune of $17.8 billion. And again, certainly not all that surprised if we look at the breakout. Taxable money market funds basically saw about $5.5 billion of inflows. How that broke out is institutional funds, so about $13.9 billion net new money coming to that group, and the retail investors put about $1.6 billion back into their coffers, again, hopefully in anticipation of buying probably better securities and all, as you take a look at that go. But as we take a look at the tax-exempt money market funds, again, people ahead of tax season are putting money to work there. $2.3 billion entering that group, and it's certainly something that we have been keeping an eye on. So again, not earth-shattering news, certainly just something that we wanted to keep an eye on. Well, that pretty much does it for me, but I think as we go forward, we're going to keep an eye on two things. First of all, non-farm payroll came in very strong, and it's something we want to keep an eye on as we go forward, because again, we're kind of concerned what the Fed would do, but certainly the market is reacting strongly to oil as it keeps declining. Well, if you want to do a deeper dive and go into kind of the areas that you do more research in, please join us at our site, www.lipperusfundflows.com, and you can do a deeper dive into that product. If not, join us next time where one of our analysts will talk about the fund flows for the particular week. And until then, my name is Tom Rosine, wishing you the best in your wealth planning and creation. Thanks for joining me today.